First idea, Alphabet.
Yeah, so I think even too with these kind of top picks today, like these are ones I really wanted to profile because I think you can play some offense and defense with all of them. And I think Alphabet is just a wonderful business, exceptionally good business economics. Their main asset is Google. Google derives the majority of its revenue and cash flows from online advertising. And so I think, in terms of more advertising dollars continuing to shift online, Google's going to be the primary beneficiary. On the negative side, there are some overhangs in terms of privacy and in terms of their online dominance, which, they're always under regulatory scrutiny. And I think there's such an exceptional amount of value in the shares of Alphabet right now. If you look at kind of just the headline price to earnings multiple, it's about 17.5 times earnings. Okay, you factor out, they've got more than $100 billion in excess cash on their balance sheet, no debt. You've got a cloud services business that's growing at 30+% per year, but it generates negative operating income right now because they're not at the scale. And then they have within their other bets some early stage technology investments that also contribute negative operating income. When you factor these assets out that are essentially a bit of an overhang on the valuation, this is a business that's trading at around 15 times earnings. And even as the market kind of goes down, Google has cash on the balance sheet and they can buy back their shares. So I think, coming out of this, there'll be a smaller amount of shares and, shareholders will accrue more earnings per share on the rebound. So this is one I really, really like.
I know, apparently Google Maps was launched back in 2005.
Yeah.
And it's a wonderful thing. It's changed people's lives.
Yeah.
But I don't recall an interesting innovation from Google in years.
No, I think their one innovation with the search. They weren't first to search, but they're the best at search. And the thing is, because the capital investment required to make search so good, it's hard to catch up, and no one's been able to catch up. I think it's north of 80% of online search goes through them. And so, that's their biggest thing. In terms of some other minor things, their operating systems are quite good, the cloud services, but in terms of a technological innovation, they're set up in a way that they can incubate a lot of interesting things, but nothing is really launched yet, just like their main product.
I mean, I know they've done stuff in AI and everything. Yeah.
And even healthcare.
Right. Okay. We better. Yeah. Brookfield Corporation, and so it's now trading under the symbol BN in New York and Toronto. It's the core company, and we talked about this earlier. You like the look of them.
Yeah. So this is the parent company. So this is a company used to be called Brookfield Asset Management. Now it's Brookfield Corp. So this is the company at the top. You can call it the parent company, the holding company, whatever you want to call it. But this is the top of the Brookfield pyramid. And why I really like the top of the pyramid is you get exposure to all of the operating subsidiaries. But they have a unique ability to allocate capital between the different subsidiaries and to act opportunistically. So, in an uncertain environment, you've got Brookfield who can, they're very, very good at recycling capital. They have collectively, Brookfield has over $100 billion currently across its various platforms for doing M&A. And so I think, this is, they've got so many levers and so much optionality to create value for you in a bad time in the market that this is, I think, and very undervalued. There's still less than 12 times FFO, a distributable cash flow yield around 5%, and you're also going to get paid a small dividend as well. So very, very attractive in this environment.
Okay, and fascinating story, obviously, Brookfield. And there are many iterations, and the way they mutate keep spinning things off. Yeah. Chartwell Retirement Residences. I think debt is one issue people are considering with this company.
Yeah, and I think this is one, look at that chart. Like, this is one that's definitely kind of down in the dumps right now. And if you look at the valuation, in terms of what they've got hit with is they got hit with, obviously, the pandemic restrictions. So their occupancy is about 80%. But then also in this inflationary environment, their costs are up. So if you look at kind of FFO growth, over the last few years, it's been very, very anemic. But I think, going forward, you have some upside on occupancy and you have some upside in terms of their developments. And so I think, people are always concerned with Chartwell about, dividend sustainability and about the balance sheet. But, they own some wonderful assets. They have some upcoming debt maturities that they're likely to refinance. And if you look at the dividend, as a percentage of kind of next year's forecasted kind of FFO, it's a little bit above 90%. So I think in terms of its dividend, is it sustainable? I think it is. In terms of the assets being massively undervalued, I think they are. And I think at some point, earlier this year, Blackstone came into, opened a Canadian office. There are parts of the market, especially in real estate, where you're seeing private equity have huge interest. You saw it with industrial properties. You've seen Blackstone come in. Blackstone, just recently hired somebody with experience in, retirement residences. And I think, there's a lot of value there, and I think there is some potential for, some type of takeout.
Interesting.